Hello, everyone. My name is Dominique, and we'd like to thank you for joining us this evening. We are going to give folks a bit, maybe a minute or two, just to log on and get everything set on their designated computers. So just sit back and relax and just wait with us as we wait for everybody to join this call.
Always hold one. Yeah, that you could do.
You sold me this
Yeah.
ticket. The same seat. I'm going to use it.
Yeah. There was always one. And there's only one place we go the hell long. Dallas.
Oh, Dallas.
Starbucks. Yeah. Yeah. But it was like big stadium, like 50,000 plus stadium, the hell long.
Pre-Jerry.
Jerry would like get with it, shoot out back.
He's losing anywhere. You can't build a TV with revenue. I guess maybe you can't now. You don't have revenue doing anything now.
Yeah.
Just,
Yeah.
everything just works. My son was a great reader because he's like, wants to buy the Lego stuff. You should earn some money. He's like, what if I just found someone that wanted to give me money?
That's even better.
That's the new strategy.
Yeah.
Find people want to give it to you. And you don't have to do anything.
Yep.
He's like, or I could do chores. It's like, or I could find someone who just give me money.
Dad.
Yeah.
Here's an example.
Right, it's looking like we have mostly everybody here. So we are ready to rock and roll. I will pass it over to our panelists.
All right, thank you everyone very much for joining. I'm Dave Codre. We have Josh Friedenson here. We have Dominique, who you kind of just saw right there. She's on our investor relations team. She's going to be helping with sort of our timeline and going over how the deal flow works at the end. And then we have Natalie King, who many of you have met before and spoken with, our investment team manager. So today we're here to talk about East Lake Crossing, which is a deal we have been working on for a few months. We have not brought a ton of apartment deals out in the past 2 years. Been a little tricky to find them, but overall, this is our 101st deal at Greenleaf. Obviously, we're very excited about that. That's a lot of growth over the past 12 years that Josh and I have really been doing this together. We started back in December 15th, 2008, so it's been a while. Over that time, we've grown not only our investment management team, but we've grown our operations team and our construction team out. And it kind of covers our overall footprint that you see up here on the slides. Since the beginning, we've always been looking to how do we add value in real estate, either through strategically buying from someone who has an asset or operating it better, or can we add value to it through construction? So we really look at those 2 points and say, how can we help generate passive income for not only our investors, but also we'll go into a little bit of our employees joining in on that now as well. When we look at where we're at now, many people ask like, hey, what does the general partner do from an equity standpoint? How are they putting money into the deal too? So Josh and I are typically investing 2 to 5% into a capital stack of a deal. We're only putting that money up front. We already, for this deal, I keep going back to Blue Sky. It used to be called Blue Sky. I won't say that again, but it's on the tip of my tongue. So we're normally pre-funding and kind of paying for the stuff to get towards the closing table. But what we've done in the past 2 years is, as many of you know, that we're a big goal-oriented organization, and we put something in place where we have not only us investing in the deals, we have our employees are able to defer some of their bonuses into an employee ownership fund, and they are able to participate in the investment proceeds as well. On the apartment side, we've exited 29, 30 deals, and our average IRR is over 30%. So it's been a pretty good run over the past 12 years. And we're excited that our employees, our investors, and us can really generate some passive income from that. So as we go into the format of today, really our goal with this webinar and other webinars is to really provide transparency, hear kind of direct from Josh and I what we see in the deal, what we like about it, kind of the financials of everything that happened. Quick couple ground rules. We're going to do a Q&A session at the end of this. Overall, we think we've got about 25 minutes here of things to cover, and then we'll try and address any questions that we have at the end. But as soon as something pops in your mind, go ahead and type that into the Q&A box. It's in the center of your screen on the bottom there. And Natalie is kind of aggregating all that and getting all the information together so we can cover those at the end. We figured that was more efficient than having Josh memorize all of the questions throughout the presentation here. So we got that part too, and then also kind of between where you see Josh and I on your screen and where you see the slides, you can slide that back and forth and you can make Josh and I look bigger, or you can make us look really tiny. Whichever you prefer as you're kind of watching, going through things here. All right, so let's get things kicked off. To start with, we're going to go over the market that East Lake Crossing exists in. So really, this is an Atlanta Metro deal. You know, this is kind of right in our backyard. It's where we've done, gosh, a handful of deals. Many of you have been investing with us for a long time. So this is on a road that we're very familiar with.
Yeah, so our fourth deal that we ever did was in the old Fourth Ward of Atlanta. If you know Atlanta, these are really granular neighborhoods that we'll talk about. But overall, this is kind of the central eastern side of Atlanta. If you're looking at the map right now, the dotted, kind of the dotted north-south line is the belt line. And we've been playing around that belt line really since 2011. Finding assets anywhere from 10 units up to 144 units. And aggregating them together, renovating them at mass scale, and then we've exited a handful we've continued to hold because the rental growth has been so phenomenal. Some of the exciting developments as we've developed apartments, a lot of other stuff has been developed. Krog Street Market, which is a big kind of mixed use retail center, really similar to the Dallas Farmers Market for those of you in Dallas Fort Worth. I think Phil, Rusty, Jeff, I think you guys are on the call. The Krog Street Market is really similar to Dallas Farmers Market. The area that we're in is a little bit further east, more similar to kind of a Deep Elm renovation area. If you can relate to that area, if you don't know Atlanta as well. Ponce City Market, which is kind of a major tourist attraction in Atlanta. It was an old Sears building, hundreds of thousands of square feet. They put hundreds of apartment units, restaurants. They put a rooftop.
There's an amusement park on the roof.
Yeah,
so
Coney Island.
it's a $4.8 billion development. So they were able to mix in some goodies with that much cash going into one project.
Yes. So as you see kind of Memorial Drive is kind of the center point, that dotted yellow line. All those little Greenleaf leaves are projects that we've done, and the ones on the map are ones that we still own. We've exited 3 or so of those over time. The ones that we still own have had tremendous rental growth, kind of at a minimum 5% a year. And over the years that we've held them. So you can see this project's really right in the middle of all these. We're really bullish on the area. So number one, we know the area really well. Number two, we know this asset type really well. 1960s built, apartment projects. We've done them a lot. We're going to go into more detail, but we've done 9 projects in urban Atlanta, and most of those were on the same street. So we're very bullish on the project. We've been working on this project since last June. We've been jokingly calling it was named Blue Sky Condos when we put it under contract, and over the last 3 weeks we renamed it to East Lake Crossing, and we're all tongue-tied trying to get that out of our mouths. So
yes.
One other point out, Paul Mendel called me yesterday. He should be on the call as well. Alliance Residential just announced that they're building 300 plus apartment units on Memorial Drive, just really east of here, really close to the belt line that I referenced, that north-south line. So that was exciting to hear, because we like playing in neighborhoods that we're kind of the predominant Class C owner with a nice new product.
Now, affordable.
Affordable.
We are the affordable, good value for what you're paying for.
Yes.
Owner.
And we're generally commanding, our basis is usually give or take, 125 to 150 a unit, looking for rents in the $1.50 range, compared to the Class A guys, say across the street, their basis is pushing $250,000 a unit at minimum, and they're looking for $225 to $250 a square foot of rents.
Yeah, and those are monster rent numbers compared to where we started 10 years ago.
Yes.
Right. We were excited when Atlanta broke $1 a square foot rent, and now some of the Class A stuff is saying they're north of $3.
Absolutely.
So rents, there's no inflation. It's just things are getting a little more expensive. All right, so let's take a look at the lease comparables of this asset and what we see kind of in the immediate surrounding market. So some of these we own. So we're always comparing to things we own and then also what the market is. If you've been with us for a while or known our kind of operating philosophy, we target a 70% retention rate. So even if the market is way up here, we're still trying to maintain retention so that we don't have mass move outs and mass lease ups. That stuff's just very expensive operationally. So if you look at kind of the average rents that you see here that are in this immediate submarket, it's right around $13.25 right now. And I know there's a mix of 1, 2, and 3 bedroom units that come in there, and we have that at this property as well. So we're renovating a project that's going to take us time to renovate, and we're targeting today's rental rates that we know have been increasing at 5 to 10%. We've had on East Side Crossing, which is just west of where this asset is, even during COVID move outs, we had 10%, 15% rental bumps on new leases just in a period of 2020 on a small number of units. So 13.25 is kind of the average of what we're seeing right now.
Yep. One nice thing about, you'll see, our average rent is, there's kind of 2 ways to look at rent more from an education standpoint. You look at it kind of per unit. You can also look at it per square foot. So the one of the comparisons you're going to look at is East Lake Crossing versus East Side Crossing, which is actually the last one. And you see we're projecting our rents to be about $200 a unit higher, but 20 cents and change per square foot lower. One of the things that we like about East Lake Crossing so much is that there's large floor plans. And we think those are more marketable, more sellable to the market. So we're excited. We think our projections are very reasonable and fair, especially assuming that we're realistically not signing the first lease for 25 months after we get started.
Correct. Yeah. So the opportunity as a whole, I'm going to run through just what this site looks like and kind of what we're paying and what we're doing to it. So you can see the outlined in yellow here. It's a rather unique plot of land. It's on a hill that overlooks basically a residential neighborhood of all single family homes around it. So this was kind of pieced together and built overlooking this neighborhood. And since June, we started a little bit higher on the contract price. Josh hammered them down a little bit. So we're coming in at $55,000 a unit.
Yep. Yeah. So part of the opportunity here is the guys that we're buying from, we bought from before. They're more land aggregators. And so the project we bought from them before, they assembled 12 acres of land, multiple apartment complexes, and some single family houses. And we basically cherry picked what we wanted out of it and bought that. And it's a very similar approach here. In about 10 years ago, during the financial crisis, these condos all went bust. They're all individually owned. They sold for $100,000 to $200,000 a unit. It was kind of all over the board, and it went belly up. And over the last 10 years, these guys one by one picked up every condo, had to chase down every lender, and they finally have achieved that goal of all 144 units. And now we're a great buyer to buy it and take it to the next level. The buildings you see our rendering at the bottom there. There's not really any great pictures of the property as is. It's overgrown with kudzu.
It depends what you get excited about. There are great pictures if you get excited about abandoned, boarded up buildings.
Yes.
But this one looks a whole lot prettier of what we're turning it into.
But if any of you want to put on some boots, definitely wear pants, definitely wear long sleeves and a hat, and want to meet us down there, we'd be happy to meet you down there and walk through and remove the boards from the doors and the windows and kind of walk through the units. Surprisingly, there is drywall. Some of the units even have carpet in them. So it's been relatively maintained. There's really not a whole lot of water damage or mold or any kind of the big red flags. We've been inspecting the property for almost 9 months now. And so we don't really see any issues with should anything have to be demolished or anything.
Yeah, no, we're confident we can get stuff done. We've done projects where they don't have a roof.
Right.
And those ones are like, man, this thing looks pretty crappy. It's because it doesn't have a roof. These all have roofs. Exciting selling point. So overall, but even to that, it's got roofs. We're still going to spend just over $10 million on renovations across this whole site. And that's everything from cutting down an enormous amount of trees on the outside and making this project workable. We'll jump into kind of what we're looking at on the renovation plan. This is where you can see what we've done on the outside, what we've done on the inside on various projects. So East Side Crossing, which is one of these, you can see it was fully overgrown. And we took all of that off, repainted the outside, and really redid everything so it looks presentable. We also have some videos too on just a lot of the renovation work we've done, especially like a heritage square where we took essentially abandoned buildings and turned them into nice livable units. And The bottom part here, you see Fairway Apartments. We've got this just a massive amount of kudzu, which grows very well here in the summer in Georgia, and just removing that and making things work. One thing we do not spend money on renovations is we do not spend a lot of money on amenity projects. We're not putting in kind of the expensive to operate pools, fitness centers and all that kind of stuff, because ultimately when we look to exit, value isn't really placed on those. Value comes from what revenue you're producing and a per unit number. You could argue that, hey, a nicer pool is going to get you a little bit more in rent, but not really. It's going to really just get you some operational disasters or headaches. So let's go through the investment overview as a whole and talk about the capital stack a little bit on what we're doing here on this project.
Yep, so we're under contract to buy the property at $8 million. We plan to put $10.2 million in. And then we have some closing costs and reserves. To go in a little bit more specific on the reserves, the $2.8 million will be basically our burn over our hold period until we basically start leasing. It's gonna be about a 24-month renovation plus 12 months to lease up. So over that time, we'll be spending money on mortgage interest and security and utilities as we're there.
Lots of mortgage interest.
Yes, lots of mortgage interest. The closing costs, these are a little bit, for the most part, the number seems really high, but for the most part, we're generally trend in the 5% range. This is a larger deal, so obviously the number's higher. On this specific deal, we're using a lender called Stancorp. We've used them in the past. This is probably our 4th or 5th loan with them. If any of you were in number 11 or number 12, Waverly and North Lake, or Don Juan, number 19, we use Stancorp there as well. They have a bridge loan product. It's a pretty straightforward product. It's 6% interest only, designed for renovation deals, and they charge they charge 1 point on the front end to them, and then the mortgage broker that brought them gets a point as well. So that's definitely contributing to the closing cost. As we go down to the capital structure, the debt versus equity, the bridge programs are designed for renovation projects, so they normally go in a little bit higher leverage. This is a 75% leverage loan, but knowing that they're creating a lot of value. So actually, I heard from the appraisal this morning. The good news is that Stancorp is designing their the loan with a validated post-renovation value per the appraiser, and the post-renovation value came in at just over $27 million. So they're looking at it saying they'll have $16.6 million of debt against a $27+ million asset. That when we're done renovating, they'll be in and call it 55% leverage. So that's why they're willing to get a little bit more aggressive on the front end.
And they only have their full $16 million out for a few months.
Correct.
Because we're going in, we're drawing all that stuff up as we spend it. So they're in a pretty good, loan to value position throughout the life of this thing.
Yes. From distributions to investors, there will be no distributions on this project until basically the end of this loan, whether it will be a sale or a refinance. So during the hold period of this initial hold period, there'll be no distributions, but an 8% preferred return will accrue during that time period.
Yeah. If we look at the pro forma, our value is all based on this. What can we turn the thing into? And then can we either get a loan against that or can we sell it? And we've done a mix of all of those over, really over 100+ deals. So it's very, it's kind of up in the air on that part on which one it could be. We're going to pick whichever one makes the most money for all of us, quite frankly. In the model that you see here, we're exiting the sale. That's the only way we can get to an IRR is if we have a sale put in there. So here you can see our projected gross rental revenue. When we look at our renovation timeline, as Josh mentioned, it's taking us about 24 months, and then it'll take us a couple months to lease up. This is 24 months out, but we've done some lease ups in the past. We leased up a project in February, we leased the whole thing in basically a month and a half. So there's a lot of demand in the market right now. So we're projecting that, 24 months out, we're going to lease things up, and you see our gross rental revenue is what our target is with our market vacancy that we have there.
Yeah, so the model here is basically showing what does a 12-year kind of stabilized projection look like that we can value the property on. This is basically using the revenue that we discussed earlier, that $13.25 a unit. And then the expenses we basically aggregated the expenses of all the other properties that we have in the immediate area, and average those out. And that's how we're getting to our expense numbers. And then the net income, as we go to the next slide, all the exit values and the IRR modeling is really all a multiple of that net income. Not to jump from top to bottom here, but if we jump down to the bottom, sensitivity analysis, you see that exit cap rate, which is, we're targeting a 5% exit cap rate. That's really just your NOI, your cap rate based on the NOI. And so right now the market is trading at 4 to 5% cap rates. You can see what happens if we trade at a 4. You can see what happens if we trade at a 6. The appraisal value of the property, I said a little bit over 27 million, but basically the exact number is 191 a unit. So we're really close to what our exit projections are as well. So we're very excited that our validations, CBRE appraisal validations are all kind of coming in to be up right about the same number.
Yeah, we have a lot of other factors on this sheet too, like total investment return, our deal level equity multiple. We put other factors in here. We're really focused on, as an organization, right? When we look at like our investment thesis, operating and capital improvements, like how much net operating income can we generate? That's where we really create value. So everything we're doing from the investment side to the renovations we make to how we operate it is driven around creating the most amount of NOI, because that's ultimately, that's the number that drives everything you see on this screen and all the metrics. That's where all the value's at. So, okay, now we're going to go into kind of our next steps. Dominique is going to lead us to the timeline of where we're at with this deal. I know we spoke that we've been working on this deal since, did we say June?
Yep.
It's been a long time, but Dominique's we're approaching the finish line finally. So Dominique's going to take from here and tell us kind of where we're at.
Thanks, guys. Again, my name is Dominique. I've probably been in communication with you guys throughout this investment process. Our main goal here is to make this investment process as smooth as possible for you. So we've outlined a couple of dates. So to begin, if you have submitted your investment interest with us, your subscription package will become available to you today, April 29th. If you have not submitted your investment interest with us, we do ask for you to submit that via email using the email listed on the slide in front of you, or referencing your deal announcement by May 6th. And then moving on, once we share that subscription package with you and you're all set up on our end, we ask all of that to be fulfilled by May 20th to prepare for closing by June 10th. So we hope that was helpful. As always, I want to welcome all of our new investors on this call. If this is your first time hearing about us, or you want to know a little bit more about Greenleaf, please don't hesitate to reach out. Myself and Natalie would love to meet you and kind of answer any additional questions you may have about account setup, investor portal. Maybe you want to know a little more details about Greenleaf as a whole and how we operate. We're here as a resource for you, so please don't hesitate to reach out. Well, this concludes our regularly scheduled program. So if you need to log off for whatever reason, feel free to do so. You will receive an email from us within the next 24 hours or so with this recorded link. So you can reference back to any of what Josh and Dave have mentioned today. With that being said, we will dive into the meat of the program, which is that Q&A section. And I'll pass it off to Natalie.
Okay, thank you, Dominique. And thank you to all of you who submitted questions to us. We had quite a few come through, which we love. Now, if we aren't able to make it through all the submitted questions, don't worry. We'll be sure to follow up with you after the webinar. So let's get started. Dave, you mentioned earlier, can you remind us how much the GP will be investing in this deal?
Yes, so 2 to 5% is our goal right now. We've spent about just under $300,000. Our target for this is we'll probably have about $100,000 to $150,000 into it, depending on kind of how the overall fundraise goes as we close things out.
And how many apartment deals have you completed your planned life cycle for and actually exited? And then just remind us what that average IRR was.
We've exited 29 deals with a 32% IRR. The average hold period has been about 4 years.
Yeah, we kind of always go in and say, hey, we're going to hold this for a
Inevitably,
long term. And then people offer us a lot of money for it. We sell it, make 32%.
Yeah.
So you guys covered sold properties, and our next investor asks, how many more apartment deals do you plan to purchase this year?
Yeah, apartment deals are, we like the heavy lift, the heavy value add, and I think our investors like them too, because we create a lot of value for really everyone involved. So in the last 2 years, we've bought, this is our fourth, fifth. So we got Fairway, Heritage, Cedar Grove, and Oak Hollow, and then Eastlake. So that's over a 2-year time period. Looking forward to the next 2 years is, the one advantage we have is we've expanded into Raleigh Durham. We've been really active in Chattanooga, so we're hoping to pick up some more, but nothing immediately in the pipeline. Hopefully one more, maybe 2 more by the end of the year, but the market's aggressive right now for multifamily.
We have a couple investors who would like to know more about the seller's profile, specifically more insight into that. And then also, why is the property boarded up and why was it a failure?
Yeah.
So the seller is a very interesting individual. So we'll start with that part, but like Josh mentioned, we actually purchased Eastside Crossing, which is just down the street, same kind of structure of boarded up units from the same seller. And they're really just looking to aggregate. In that situation, they bought 112 apartments surrounded by like 50 individual homes that they kind of aggregated all that land. And we kind of killed their grand vision and just pulled out the apartments and bought it. And then on this one, they just have apartments here, but they have some land around it with the townhome stuff too.
Yeah. So this part of Atlanta was, this is kind of urban infill neighborhoods. This hasn't really been, really any of our major cities in the US, it hasn't really been a in vogue place until really the last 20, maybe 25 years. So a lot of our cities, like I referenced development Dallas, is really similar to this type of area. That is going through just major gentrification, people moving in, and for example, the home values around Eastlake are now, they're now trading for kind of pre-renovation in the mid to high 200s and post-renovation for the mid 500s. So that's a significant, neighborhood, relatively speaking. But yeah.
Okay, can you remind us why we're willing to pay $55,000 for boarded up units?
Yeah, so we're going to be all into these for about 126 in hard cost, and really at the end of the day, new construction apartments are well over $200,000 a unit. So in relation to new construction, yes, we're not going to get the rents that new construction gets. We don't need the rents. We're in at such a lower basis. So being at 55,000 a unit, these units are just under 1,000 square feet. So it's basically $55 a square foot. It's a really good position in where the market is and construction costs are right now.
Our next question is, wouldn't it be more cost effective to get a construction loan at a lower interest rate rather than getting a bridge loan at 6%?
Well, we look at that in 2 ways. One, this construction loan is interest only the whole time frame. So our actual cost of debt is lower. Most of our, I would say, other types of construction loans that we've received, we have a kind of a terminal point where the construction loan turns to principal payments as well. And then when we kind of factor that option in with this option that's interest only the whole way, this one had a lower overall cost. So we wanted more of the approach of what's the less total dollars between now and out 4 years versus a kind of a standard loan that we've done with more of the community banks around Atlanta.
Yep.
Which also all disappeared.
Right. Yeah.
So
and rates, we're we're paying 6% here for construction loan debt from a community bank. We're probably looking in the 4.5% range. So even if we had that, you're talking 150 basis points, but it's usually a shorter amortization, usually 20 years, and you have to start paying principal much sooner. We literally modeled the two side by side and decided that this was a more cost-effective approach.
Okay. We have another great question around construction. It appears that there are bottlenecks in the residential and apartment construction material supply chain, some of which are leading to drastic cost increases in some materials. Do you see these bottlenecks impacting either the projected cost or the projected timeline of this project?
We kind of put a buffer in for all of that stuff. It's definitely well known that lumber costs are now way up compared to where they were. So when we went into the design phase of how we're doing this, we're like, how do we make sure we can do this with keeping as much of the framing and everything intact that we can to minimize our lumber costs? But there's also supply chain constraints of like just getting tile into the US as a whole has been a challenge. So all that stuff, when you used to be able to say like, hey, I'm gonna order this a week out and I'm gonna get this from Floor & Decor or one of the industrial suppliers, it's like, it's more like, let's order that stuff 6 months out and make sure that we can take delivery of those items because they may arrive at variable time points. The kind of just-in-time delivery model has that kind of exploded. That's essentially gone. So what we're doing now is we're getting shipping containers on site that we store everything in and are secured so that we can order parts now, pay for them when we're getting them, and then store them on site so it meets our timelines. That's how we're getting around the supply chain constraints.
In addition, you know, compared to other projects we've done, we started the permitting process substantially sooner.
Yeah, we on the permitting standpoint, you know, a lot of stuff happened in COVID. We're like, hey, the cities are going to shut down, and now it's really hard to get a permit. But what they actually did was allow us to use third-party permit expeditors to do the actual inspections. So our permit process is actually going faster now that the cities and counties are shut down. So maybe kind of a little counterintuitive, but it's actually been helpful. So we will have permits for this project right around the time that we close, which is about 3 months faster than we've had it in other projects.
That's a great segue to our next question of will this project require approvals, and what would those be, and what are the timings of those?
Yes, it will require approvals. What all of those are, I mean, it's essentially a full build approval process. We have to get everything from Georgia Department of Transportation, which will verify our entrances. The fire department does all the I can't what are those things in the ground?
Egress or hydrants.
The fire hydrants, whatever those things are called, right? All the way up to Georgia Power with all the utility connections and all of the mechanical. So we're getting permits and approvals along the way for all of that. But we do expect to have all of the utility, mechanicals, architecture, interior, exterior stuff, all that done in the first week of June. Right around the time that Dominique mentioned, we have the closing for this. We'll have all of that stuff done.
You know, one advantage that we have with condos is a little bit more flexibility by doing unit by unit or building by building permits versus, you know, if you look at a new development site where you literally have to do the entire, say, hundreds of units at once, we'll approach it more building by building or unit by unit and have that flexibility that we can say, hey, the 2 entrance buildings, let's look at those online a little bit sooner. And we can still work on the back buildings as we lease up the entrance buildings.
Josh, we had an investor question of why is this a condo community, which is stated in the investment overview? Can you answer that one?
Why is what?
This considered a condo community.
Yeah, so.
It just is a condo.
Yeah. They sold them off as condos and said, you know, it probably was built originally as apartment complexes, and then there was a condo phase through Atlanta, and so someone bought them all and then put an HOA in place and broke them all apart as individual units, and now it's coming back together.
Yeah. This is our 4th condo deal that we've done. So we've done apartments to condo, like legal conversions, and then condos back to apartment legal conversions. So we've done 4 of them. Not the fact that we're like buying and selling condos. That's not our business. We haven't done that. More just from the legal documentation of what they are. So we're pretty comfortable with what the structure looks like on the condo side.
One benefit they have is that their tax assessed values will remain very low until that full conversion is done, because they are in relation to each other and they all sold to the guy we're buying from for $1 of $5,000.
Yeah, and even at $50,000 a unit, taxes are pretty cheap on that price point.
Compared to our other apartments that are being valued at $100,000 plus down the street.
So we have another condo question. Considering these are condos, is there a possibility to sell the units individually as condos? Would that be more profitable?
I mean, if it is more profitable and it's feasible in 3.5, 4 years from now, we'll have another webinar and explain how we learn to sell condos and try and tackle that one. Right now, we're kind of just sticking with the bread and butter of like we would look to sell it as a whole functional deal. But yeah, I mean that's certainly an option, and we're not changing anything to remove that potential in the future. We like that as a kind of just another avenue you could go down, but not a specialty that we have.
Right. And the market that it's in doesn't necessarily have that track record of having condo sales. So it's something we'll figure out over the next 3 years to see if it's in play or not.
Our next set of questions have to do with distributions, investor returns. So can one of you tell us what the difference is between cash on cash returns and total investment returns?
So so cash on cash returns is basically the free cash flow after paying basically everything that's happening in the deal, basically what's net. Total investment returns include balance sheet items like principal pay down.
And what about distributions? When will those start? And can you tell us how that will work for a new investor?
And so there'll be no distributions on this property until the end of really the deal cycle, which is at a 4-year horizon. And at that point, we'll be talking lots between now and then every quarter on updates. But at that 4-year horizon, we'll be looking at saying, hey, right now is the best opportunity for this property is to sell it, and there'll be distributions from the sale, or right now the best opportunity is to refinance, and there'll be distributions from the refinance. But there'll be nothing between now and that capital event.
We have some exit questions. If you exit at a 6% cap rate, will you still be able to make the 8% preferred rate?
I would have to look back at the numbers.
Okay.
But
Well,
yes,
follow up
the
on that
total,
one.
that has a total investment return on it. So we're still making, so we're pulling up the
Yeah.
exact number on that one.
Yeah, it looks like a 6%. If we exit at a 6% cap rate, we'd sell at 160,000 a unit, and our IRR would be roughly 6.8%. So we'd probably be just short of that, meaning that as the sponsors, we don't get paid for all that effort, and investors get paid 6.8%.
Yeah, but the profit on that is still it's about $4 million of profit, $4.5 million of profit. So our investor equity going in is $5 million and earning 8% a year. So that's $400,000 a year.
Mhm.
So that'd be 1.2 million of prefs owed over a 4-year period. And we would still make about 4.5 million of equity on it. So they'll still,
Okay.
there'll still be profits above the preferred return at a 6 exit.
Our next question is about hold strategy. So you mentioned that we're still holding some previous deals. What's an investor's exit strategy if Greenleaf's exit strategy changes from selling to holding down the line in 4 years?
We're a little bit married at the hip on these deals. The one part we've always done is we've done them as individual assets. So we don't really commingle stuff. That allows us flexibility on a deal by deal basis. But for the most part, we're looking at syndicating. We put the deal together and stick with it through the life cycle of what we're doing. And that's why we kind of have this 4-year horizon Josh is talking about, where we've got to make a decision at that point of, are we going to get a new loan? We get a new loan and we're going to go sign on a 5-year, 10-year loan. It's like, hey, we better all want to do it another 5 or 10 years with this, or we can exit it at that point. It is hard to exit in the middle of those kind of critical timelines.
Right, but if we decide to keep going after the 4 years and an individual investor wants out, that's usually an individual conversation of how we want to handle that. Over the 101 deals we've done, we've had very, very few exits, like 3. And they were really for life events more than anything. So we accommodate those the best we can. It's been a very positive experience for the 3 people that have had to exit earlier than the deal did. But it's a case-by-case situation, no promises.
Another construction question just came through. If the construction is taking 24 months and then there's 12 months for lease up, why would there not be cash flow during the 4th year?
Well, there will be cash flow coming in. We're just not planning on distributing it. Because if we do 24 months of construction, 12 months of lease up, then we need 3 months of real actual stable operations to go pitch that to a new lender to see if they're willing to place debt on it. So before we make the decision on, hey, do we want to sell this or refinance this, we got to be able to get to a position that we can see both sides of the picture. So that puts us at that 3 years and 3 months standpoint. And really in the middle of that, it's like, okay, at that point, we'll have a decision of what we're doing, holding or selling, and we can really make the call from there on distributions.
Back to the sell versus hold, does refinancing imply holding the asset?
Yes.
Well, our last question should be an easy one. What is the minimum investment?
25,000.
Wonderful. Again, we thank everyone for submitting your questions to us today. And if we didn't make it to your question, we'll be sure to follow up with you after the webinar. And of course, we want to thank our hosts, Dave and Josh, for sharing their insights with us on East Lake Crossing. As we wrap this up, just a friendly reminder that this webinar is being recorded and you'll receive a link to the presentation over the next 24 hours. And in the meantime, though, if you haven't done so already, you can review further deal information, submit your investment interest, and register for our upcoming webinars by clicking on the link that Dominique is going to message out to everyone right now here during the webinar. So this concludes our webinar, and we certainly appreciate you joining us today. Thanks and goodbye.
All right, thanks, everyone.